Rich Dad, Poor Dad is one of the New York Times best-selling books written by Robert Kiyosaki, which promotes financial literacy, financial independence, and wealth building. In this book, Robert Kiyosaki emphasizes the importance of a strong financial education. According to him, being rich is not about how much money you make but how much you keep. Learning the difference between assets and liabilities is one of the essential things that you must know if you want to become rich. In this video, you'll learn the difference between assets and liabilities from Rich Dad, Poor Dad.
By the way, if you like this type of content, be sure to hit the like and subscribe button.
Most people have financial difficulties because they confuse assets with liabilities. Maybe because these financial concepts are not taught in schools. Or, accountants tend to complicate them, making it hard for us to learn the difference. In Rich Dad, Poor Dad, the rich dad gave a straightforward and simpler definition of assets and liabilities. What is an asset? An asset is something that generates income. In the book, the poor dad claims that his house is his biggest asset. It shows that he doesn't have a firm grasp on the concept of assets. A house is considered a liability unless it generates income. Your house can only be an asset if you can sell it at a profit. Renting your house also makes it an asset. If you can collect monthly rental payments more than the amount of money you spend on operating expenses, you can earn a net income. On the other hand, your house is a liability if you spend money on it monthly, through mortgages, property taxes, insurance, and repairs. During the Great Recession, the foreclosures and short sales of houses made people realize that their house was actually a liability. Businesses, real estate, and dividends from stocks and bonds can be regarded as assets because they provide a steady income stream. Many self-proclaimed financial experts and accountants will give you a complicated mathematical definition of what constitutes an asset. Still, the truth is that if it isn't making you money, it isn't an asset. What is a liability? A liability is anything that makes you spend money. Typical liabilities include car loans, restaurant meals, vacations, subscriptions, and other expenses. Some things that people consider to be assets are in fact liabilities. This misconception can be attributed to their low level of financial literacy. Others also blindly follow the recommendations of the so-called financial experts. However, people sometimes must spend their own money to acquire something only to sell it at a higher price. Since you can profit by selling it for more than it costs, it is considered an asset. Rich versus poor. To put it bluntly, the wealthy don't have to work for an income as regular people do. Real estate, stocks, bonds, and intellectual property are just some of the assets the wealthy put their money into because they know these investments will generate additional income. Rich people prioritize growing their assets. When you examine how poor people budget their money, you will see that most of it are spent on liabilities such as mortgages, consumer loans, and credit card debt. There is no easy way to financial independence. It will be much more difficult if you lack the foundation knowledge, such as learning the difference between assets and liabilities. If you want to become rich, start investing in your financial education. Learn how to acquire, grow, and keep your assets. That way, you'll own more assets and spend less on liabilities.
We hope this animated video has helped improve your financial literacy. We do our best to provide actionable tips that are easy to digest and implement in real life. If you want to see more of these videos, please leave a like and subscribe to our channel. Also, comment what makes you feel inspired, motivated, and excited.
Thank you so much.
That's more than enough to help us grow and sustain our production expenses. See you in our next video.